Okay, for our final presentation this morning, we welcome Justin Shepherd. And Justin is a senior economist at FCC. He joined the team in 2021, specializing in monitoring agriculture production and analyzing global supply and demand trends. He grew up on a mixed farm in Saskatchewan and remains active in the family operation. He holds a Master of Applied Economics and Management from Cornell University and a Bachelor of Agribusiness from the University of Saskatchewan.
Good morning, everyone. Thanks very much for having myself and Farm Credit here to speak today. So today I'm going to talk about looking at some of the chaos in the world. I think Josh did a good job highlighting the fertilizer market this morning, so I'll try to avoid most of the fertilizer stuff because he did a good job, and then look importantly at opportunities, that even though there's always going to be challenges, there's always going to be issues, there's always going to be things like weather that we really don't control, there's still a lot within a farmer's control or within producers or the industry to take charge of this year and to really manage what you can. So as mentioned, from a farm in Saskatchewan, so we actually grow hops, which I would say Eastern Canada is fairly well known for. So that's my daughter. She's on her way out today, so I'm getting a chance to explore PI, which I'm really excited for. First time out here. We do put out content, so we are writing, most weeks we are putting out either a blog or we're putting out knowledge to our lending staff who can share that. So we do have stuff coming up on financial markets. Farmland Values comes out March 24th, so that will update 2025 farmland values. We also are writing and we'll put out a blog on what's going on with fertilizer prices. So we expect that to come out next week. We obviously hadn't planned on doing that, so that's why it's not on the slide. But what's been going on the last few days is worthy to talk about and to share knowledge both for producers, but then also for our own staff to make sure that we're better able to support the industry. So looking ahead to the U.S. or MCA or CUSMA negotiations, and it's not really a negotiation, it's supposed to be a review this summer. So it's a review in the sense that the parties meet, and in theory, as long as everyone just says, yes, it's fine, it would go on for another decade. Even if somebody chooses this summer to say, no, we don't really like it, it's going to end, at that point, it still has another 10 years to run its course. So it's not like it's not a full, or it's not supposed to be a full renegotiation. It may end up becoming that, but how the structure of it is that it's supposed to be a meeting, a discussion, and as long as everything's okay, it's going to be around for at least another decade. It is possible that there are changes made to this trade deal. One of the statements last week by the U.S. Trade Representative was that they are looking for some sort of flat tariff on everything that Canada exports into the United States. So they are going to be asking for different things. They're looking at dairy access. But for right now, we don't know what it's going to look like. It's going to come up this summer. It's going to be in the news a lot. It's important not to react to everything that's said or comes out. It will take time to work through. Ultimately, and as the minister this morning said, that industry in the United States wants this to happen. They are very happy with working with Canada, with working with Mexico. So the business environment or the business community wants this trade deal to continue, and while there may be some changes made slightly, ultimately they are looking for it to carry on. One thing that's been interesting is that increasing tariffs really means that there's no win-win solutions anymore. So for the last 100 years, the U.S. essentially has seen their tariff rate go down every year. So there's no generations in the room today who have been in an environment where we are seeing this sort of tariff or this sort of, we're going to use tariffs to fund a government. We really are 100 years where it continues to go down. So you can see in the last year where the effective rate in the United States is nearing 20%. So the U.S. is using these tools. 2 weeks ago, the Supreme Court actually struck down one of the sections of tariffs that were placed on Canada and other countries. In the meantime, President Trump has said he will just use a different section of tariffs, so they are still going to exist. But in the meantime, there's a lot of, I would say, issues in the United States there's roughly $175 billion of tariffs that importers paid and then ultimately the U.S. consumer paid. And right now, since those tariffs are no longer legally valid, that money is due back to those importers. So what's happening in the United States is a pile of lawsuits where importers are suing the U.S. government. And does it ultimately mean that the consumer who paid those higher tariffs are actually going to get that money back? And probably pretty limited chance of that. Probably the importer will get that back. The administration has said they will fight those, that they will fight the refunds. So that's what I mean, that right now, with our trading partner to the south, there are big challenges that they are facing within their own country, let alone what the impact is on us. So the Bank of Canada is looking at all this and saying, what do we do? This is very, there's a lot going on right now, both in Canada, what we control as an economy, but then also what's going on around the world, and then what's happening with trade, which we are heavily reliant on trade, and it matters to our economy. So the Bank of Canada recently said that the overnight rate, or so what variable rate money would be priced at, has fallen low enough. It doesn't mean that it's going up or it's going down necessarily, but for the time being anyways, they say that where we are, we're going to wait and see what happens. So it just shows that the Bank of Canada is uncertain. Even if we see a trade deal made this summer and it happens really quickly and relatively painlessly, the Bank of Canada doesn't necessarily see that all of a sudden Canada as an economy is all of a sudden going to take off and outperform. It means that the trade environment and the environment to date is constraining and holding back Canada, as well as some domestic structural issues that we have. So GDP growth this year is expected to moderate. In theory, the Canadian economy, if it's cruising along at kind of just steady state, it should be about 2% GDP growth. That's roughly where the economy should sit. So you can see for 2025, we were below that, and 2026, we're forecast to be below that even further. So again, just shows that the Canadian economy is slowly slowing down. It doesn't necessarily, that's Canada as a whole, it doesn't necessarily mean that's what's happening for agriculture. Agriculture can diverge from how the overall economy is doing, but it does show that Canada in general has had slowing growth. Looking at interest rates, so I talked about the Bank of Canada. They control the overnight rate, which is variable rate money, or when you're looking at that. And so that's heavily influenced by the Bank of Canada. It's heavily influenced by what's going on in Canada. So short-term rates in Canada are ultimately what's happening here matters. But when we actually go into longer-term rates, it's not showing up on the slide, but if you're looking at 5-year, 10-year money, ultimately that influence comes back to what's going on in the United States. So we have a chart next that shows why that's the case. But if you think in Canada, what happens in the short term is going to be influenced by Canada, but longer term influenced by the United States. And obviously when you look at what's going on in the world today with war, with issues happening, that means that those events are impacting that the longer term fixed rates in Canada might be. So the overnight rate, and then the 5-year government of Canada bond yield, you can just see they tend to move in similar patterns, but at sometimes the overnight rate does get above bond yields, but not traditionally. So what's driving long-term bond yields? It's really what happens in the United States. So the 5-year bond is what, if you're going in to get for myself, I'm buying a house, when I look at what ultimately I get from the bank, or if you're looking at buying some farmland, you're looking at longer term rates. What happens in the United States impacts Canada. So it matters, ultimately, you can see how close they track. It's not the Canadian bond that's driving this market. It's ultimately the US market is moving and we are reacting to it. So what happens when something like the US in Iran occurs? So obviously at that point, our bond yields are going to go up because the market needs more risk premium from US bonds. So that has a tendency to increase bonds in Canada as well, which is going to put a lid or at least reduce the potential that bonds drop in Canada and that we actually see lower fixed rates. The other thing that the United States is doing, and that is spending a lot of money. So this is the US budget deficit. So the bottom line is what it was before the One Big Beautiful Bill, and then the line on top is afterwards. So the recent One Big Beautiful Bill that was passed, they're going to spend a lot more money in the United States. What happens with that is that, again, if you're a global investor, you're looking at the US bond market, you need more premium or more, you're taking on more risk because the US is spending more money and there's a higher risk of default. Even though there's a fairly limited amount of default in the United States, it still exists and it gets priced into the bond market. So in Canada, what's going on with the Canadian dollar? These charts were built on Monday, and I would almost say that since what's been going on in the world since then, they may not be super relevant already. It's challenging with how quick some of these are moving. But right now, the overnight rate in the United States is about 4%. In Canada, it's 2.25. So again, there's money going to flow to the United States because of the interest differential in the overnight rate. So this, in the short term at least, puts pressure on the Canadian dollar. The other thing that the Trump administration has done and cares about is actually they want the US dollar to go lower. This was very much a term one plan for them, and it worked. So during that time period, the US dollar did go lower. And so they would like it to go lower again so that they can export more efficiently to the world. So why does this matter? Ultimately, for Canadian producers, we are importers of things like fertilizer, we're importers of things like equipment, but ultimately then we turn around and sell our grain into a global market. So for the grains and oilseed producers, there are pros and cons with a dollar at this level. Overall, it's beneficial for our sale price. It helps when grain gets priced in Canadian dollars per ton, so that's helpful. But it does impact, and especially right now when we're looking at higher fertilizer prices, a lower dollar is not necessarily our friend. So for the year ahead, we have roughly a flat Canadian dollar around that 72 to 74 cent mark, but it really will depend on what goes on both with CUSMA, how quick that gets renegotiated and looked at, as well as some of the geopolitical events that are really challenging to know what's going to happen today, let alone 6 months from now. So I guess my conclusions don't pop up. In summary, we're looking at there's probably limited ability for fixed rates, especially longer term, to drop, just because we're so closely tied to what's happening in the United States. The more volatility there is in the United States, the more likely that their bonds go up and ours are just going to follow. For the overnight rate or for variable money, we're seeing the Bank of Canada on a pause right now. So it really depends how the year goes. We could see a rate cut if they need to kind of get things jump started, but we could also see a hike by the end of the year. But right now, the Bank of Canada is really just on pause, waiting to see how things play out in the first kind of half of the year. At the end, we always have a statement that says all of this is barring some sort of event we can't foresee. If I'd presented a week ago, we wouldn't have foreseen the invasion into Iran, for example. So we continue to just deal with scenarios as they come up, and that's why for us, we are continuing to put out information, why we're putting out a blog on fertilizer next week, which was not our intention, wasn't in the plans, but we think that it's useful for producers to see. And Merle said it best, are the good times really over for good? Let's talk about agriculture now. And I don't think they are. When we look at agricultural margins overall, it remains in good shape. So this is all of Canada, all sectors. The overall margin for 2025 is going to be just under 10%. So historically, a fairly good margin. Again, this includes all sectors. So there's going to be, we've seen grains and oilseed tighten during that time. But then on the other hand, we've seen livestock have a very good year and a half, especially when we look at cattle, when we look at hogs, dairy. So livestock is supporting the margin at this point. We're coming off 2021 where the opposite was the case, where it was really grains and oilseed at that point that was driving that margin across Canada, and livestock was a bit tighter at that point. For the year ahead, we do expect farm cash receipts or revenues to grow, but it really comes down to costs. What is it going to cost to grow the crop this year? So there's probably not a huge amount of upside in this margin for the year ahead, even though livestock is probably set to continue doing very well. The grains and oilseed side is definitely going to hold that back. Touching on into grains and oilseed from last year, overall Canada had a banner year last year. We set a new record for production. Canada produced 107 million tons from coast to coast of all grains and oilseeds, so a very good year. Set a bunch of yield records. For most of the crops that set records are based in Western Canada, so whether it's canola, flax, oats, there's a lot of oats grown here, but again, the reason we set records was because of what happened in Western Canada last year. So overall, Canada had a very good year for production. So we know that right now we're kind of facing, Josh touched a lot on the input side of things, but when we look at revenue and we look at price, we're also having to readjust from the last 5 years of where prices are at. So if we went to a 10 or 15-year average, prices probably sit kind of around average. But when we look at the last 5 years where we had very high prices in there, whether it's corn, whether it's soft red, soybeans, we're towards the minimum of the last 5 years. And again, that just takes time to adjust as a producer when we're looking at our budgets. So we've seen commodity prices come back down to where they historically maybe were at, but we're not necessarily seeing that on inputs. We're dealing with whether it's higher fertilizer, higher chemical, fuel this year, and equipment as well as land has continued to go up. So we're seeing costs continue to grow, but we've just seen revenues come back down to where they were. The USDA recently, this is US soybean to corn futures. So if soybeans are $10 and corn is $5, you have a ratio of 2. The higher that ratio is, the more likely U.S. farmers are going to plant soybeans. The lower the ratio, the more likely they're going to plant corn. So when we look at, to start the year, that ratio is heavily favored to soybeans. The Canadian producer uses these kind of ratios a little bit, but for the U.S. farmer, it definitely sets market expectations for things like fertilizer. If the U.S. farmer goes out and plants a lot more corn, it's going to drive up nitrogen costs in spring. At the moment, we're looking at it is favoring soybeans. The first USDA report a few weeks ago came out and said that U.S. farmers were going to plant about 4 million more soybean acres than last year and about 5 million acres less corn. So farmers are reacting to that ratio. In Canada, we don't tend to react to it as much, but it is something to watch for, again, especially on the fertilizer side of things. Overall, we're still looking at a big Brazilian crop in the world right now. They are harvesting that at the moment. So there's really, we've had 3, 4, 5 years where, for the most part, crops in the world haven't had issues. We've had small pockets here or there, but we've really had multiple years where the big producers in the world have always had good crops, and that's weighing on, that's why we have such heavy supplies in the world. Demand is up. We're using more of those products in the world. But to be honest, the producer does such a great job of increasing production every year that's what we're dealing with at the moment. Farm equipment purchases are definitely shifting from a want to a need. I think this would be pretty favorable or pretty common across the country. We're seeing weak demand, and that's limiting equipment sales, and that may pressure used prices. We do have to keep watching. There are still steel tariffs that are in place both in Canada and the United States. That's going to impact farm equipment. And then really we're encouraging or talking about this focus on efficiencies, that we're trying to match farm size to equipment capacity. Most producers in Canada, and maybe it's not specifically to here, but most farms in Canada would be considered over-equipped. So whether that's actually downsizing some equipment may be an option, or the preferred choice, I'd say, for most farmers is how do you add a few more acres to actually make sure that you're maximizing the cost structure of that equipment. So we've seen equipment cost per acre continue to grow, really started in 2021. Equipment manufacturers know margins as well as anyone, so they've done I would say, a very good job of capturing some of that margin that's gone up. So we don't necessarily expect farm equipment to be priced less. Maybe it slows down some of the price appreciation for the next few years, but historically we don't tend to see large retracements especially in new equipment costs. I'm not going to touch on fertilizer. The Middle East is a concern. Josh covered that very well. One thing on the price of nitrogen. So there is some data in Canada when we look at how much nitrogen is used as a country and what the price is, that ultimately there is going to be demand destruction from higher price of nitrogen. So the last few years, where 22 and 23 we saw nitrogen around that dollar. This is actual pound of nitrogen. We did see a lower amount used per acre. I think we would expect to see that again this year, where if we originally expected we'd be around that 2025 level, but now we're obviously going to see prices go up. So I think producers in general are going to react by using less overall. How that's done per farm and per province is going to be very unique, and it's going to be, that conversation is one to have with both, I would say, your agronomist as well as your banker, to be aware of, are you trying to continue to use similar rates to push yield, but is that actually going to be pushing your profitability into an area where you don't want to be? So the other problem, especially for the West, I know here fertilizer deliveries are maybe more as you need it. In the West and in Ontario and Quebec, a lot of farms didn't do their normal pre-buy in fall. So those producers would be now coming to the market to buy this spring with the hope originally that prices will have gone down, and that obviously has not occurred this year. In the last 10 years, there's been years where the price has fallen in spring, so that's been a good strategy. But again, we just don't know. When we're looking at fall, it's really hard to make those decisions. And as Josh said, again, if you're buying fertilizer, that's your opportunity to sell some grain at that same time and make sure that you're paying for that fertilizer that you're buying. And then I'm going to close on farmland values because I think it's interesting. And this is a lesson that was from my dad that turned out not to be true. Spoiler alert, your dad doesn't know everything. So when I was a kid, he said we should always buy farmland, or we should buy farmland because they're not making any more. And that was his statement. And you know what, in places, I would say PI's done a pretty good job maximizing your acres. And my farm in Saskatchewan, there really weren't any more acres around. So in that theory, that made sense. But it turned out not to be true in the rest of the world. So when we look at on the far right, so Brazil stands out. So this is just corn and soybean acres. So in the last 20 years, Brazil has added about 80 million acres to their harvested acres. So for context, last fall, Canada harvested 77 million acres across the entire country. So in 20 years, Brazil has added 80 million acres. They've added about 180 million tons of corn and soybean to the world production. So very much, we maybe aren't making more land in Canada, or very small amounts, but the rest of the world is. So whether it's in Brazil adding that, whether it's the rest of the world, China's added nearly 40 million acres in that time period as well. So we are seeing our competitors in the world are adding acres. It's something to be aware of. Canada does a very good job of producing high quality, fairly well traced commodities. So whether it's canola in the West or in Ontario, there's soybeans, and then things like IP or food grade soybeans. There's a lot of livestock demand for this feed. So Canada has done a really great job at exploiting or finding markets and being able to send them around. But it just means that when we're thinking about how we compete in the world, we compete on a bit of a different plane than maybe the United States or Brazil, some of these places which have had the ability to add these acres and push that production. And that's really who's gained market share in the world, and why why Brazil in particular has become so important when we think about corn and soybean futures prices, where it used to be, like in theory, the Chicago futures price is a U.S. futures. So it's supposed to represent fundamentals in the United States. But some of those contracts, like the November and December contracts, really represent the United States. But when we look at the time right now, where we look at March, for example, those are really become South American futures contracts, where the size of their futures and the size of their crop, how they're moving it, is really reflected in how the early part of the year contracts are being priced. So ultimately, Chicago futures is technically a U.S., but it really does represent a global price with what's going on. So as I mentioned, Farmland Values comes out in a few weeks. So March 24th, the new Farmland Value Report comes out. So that will give a update for all the provinces, and it also goes into regions. So in PEI, then it's broken down into a smaller regional area of what farmland values are doing over the last year. So last year, for comparison, Canada was up 9.3%. I think it's going to be up fairly close to that again this year. A bit different. I think most of the growth continues to be structured in Western Canada. The prairies continues to see land appreciation, and that's maybe 80% of the land in Canada is based in the West. So the overall Canada number is very heavily influenced by the prairies. Eastern Canada, PEI was up 1.5% last year. I think it's going to be up a bit more than that this year. But in general, we're not seeing huge growth, and it's definitely slowed from 2, 3, 4 years ago where we saw double-digit growth every year for a few years. So it is slowing. We're not necessarily seeing negative values, but it has slowed. This is the mid-year update. So we do a mid-year. As of June 2025, PEI was up 2%, New Brunswick up 9.5%, and Nova Scotia up 1%. There's no data, or we don't have enough data for Newfoundland to share that. So in general, at the midpoint last year, they were still up. I would expect kind of to see similar values as that in a few weeks. But have a look. There will be a blog released around that going into more detail as well. And then just showing an example for producers. This is if you made the decision in 2020 to either rent or buy ground. This assumes that you signed at that point a 5-year mortgage or a rental agreement at those 2022 values. And we'll start with Nova Scotia, New Brunswick, because they're easier to explain. So in that time, there's been land appreciation, so along the x-axis. So if you'd had that land for 5 years, your land has gone up from anywhere from $500 to $1,500 an acre. So as a landowner, as an investment, that's good. But if you'd instead chosen to rent in that time, you would have additional cash flow. And that additional cash flow is especially important if you're a young producer. So there's always trade-offs when we're looking at buy or rent land, and it depends on the time when you're looking to do that. So in that time, it would depend on everyone's stage in this room what you preferred. If you preferred additional cash flow overall in that time, or if you preferred additional equity build in the land. PEI is interesting because in 2020, it was actually cheaper to buy land than it was to rent at the rates that we had. So that's why PEI looks different than the rest, because you had land appreciation if you had bought, but it was actually cheaper to buy than rent in 2020. So based on that, you would have been better off to buy in that land, and you still would have gained more cash flow than you would have by renting. Of course, this is a very specific point in time. It doesn't reflect every year since then. So stage of operation matters where you're at. And then there's also no guarantee if you make that decision today, if you're looking at renting or buying, that this chart will look similar. We would probably expect, and like the feeling of land tends to go up over time. If you buy land today, it's probably, not for sure, but it probably appreciates and goes up. But if you look at the rental rate versus the purchase ground cost today, it would actually be more cost efficient to rent. That assumes that you're able to rent. That assumes you're able to buy. There's big assumptions there on, is there access to that land at all? But just a way to think of that, over time, there's no guarantee that if you're choosing one or the other today, that in the future it looks the same. And then this is our affordability index for newly purchased land on the top and then owned land on the bottom. Overall, Atlantic Canada, the affordability of land here looks better than every other part of the country. So I give yourselves credit for that, for both maybe not running up the land market like some other parts, but also then driving revenues and actually keeping that in check. So overall, the affordability for Atlantic Canada is quite good, especially relative to parts like Ontario and Quebec, and even compared to Western Canada right now. What causes affordability to improve? Ultimately, we can see lower interest rates. Obviously, that helps. That lowers your cost to finance that land. Farmland value growth slows, or at least if it trades kind of sideways, that's going to help affordability. The other key metric here is revenues increase. So if you can find a way or find ways to increase revenue, then that's going to drive and make affordability of that land look better. Obviously, most of these things, when we look at interest rates and maybe farmland values, that's probably out of your hands a little bit. But ultimately, revenue, what you're growing for yield, how you're marketing, that's definitely much more within control. But overall, this is just to show that Atlantic Canada has done is in a better position from an affordability of the land perspective than I would say the rest of the country. So takeaways, we would say Canadian economic weakness is going to continue in 2026. We obviously have the unknown of the CUSMA renewal, maybe into renegotiations. And even if we do see a quick and speedy win from that trade deal, it doesn't mean that Canadian economic weakness will not continue. CUSMA renegotiations are a key watch item. Perhaps in PEI, there's maybe not a huge amount of, there's going to be some maybe more impact on things like vegetable, maybe more into potato, which would be the issue on some sort of tariff. A lot of the grains and oilseed that are consumed domestically aren't as big of a deal, but still very much a watch item. And then crop margins, again, this was as of Monday, that they look similar last year. They are now worse than last year, just based on the last few days what fertilizer has done. So that is now no longer true. And that fertilizer remains an unknown going into the spring. We just, unfortunately, when we look at how quick things are moving, we just don't know what it's going to look like kind of next week. But we will do our best to keep people informed and definitely reach out, like when we're talking agronomists or people to talk to, but also with everything going on, being good friends or being aware of what your banker knows is always important as well. So thank you very much. Appreciate it. Do you want to